The United States has faced several financial crises throughout its history, each leaving a lasting impact on the economy and people's wealth. These crises have led to stock market crashes, bank failures, unemployment spikes, and changes in financial regulations. Understanding these events can provide valuable insights into economic patterns and help individuals prepare for future downturns. Here are the 10 biggest financial crises in U.S. history and their long-term effects. 1. The Panic of 1819. The first major financial crisis in U.S. history, the Panic of 1819, was triggered by the rapid expansion of credit and land speculation. When the Second Bank of the United States tightened lending policies, businesses and individuals struggled to repay debts. This led to widespread bank failures, unemployment, and a severe economic downturn. The crisis exposed the dangers of uncontrolled credit expansion. 2. The Panic of 1837. A result of President Andrew Jackson's decision to eliminate the Second Bank of the United States, this crisis led to a collapse in land values and widespread bank failures. The U.S. entered a deep economic depression that lasted nearly a decade, with businesses closing and unemployment rising. This event highlighted the importance of a stable banking system. 3. The Panic of 1873. Fueled by overinvestment in railroads and industrial expansion, this financial crisis led to the failure of major banks and businesses. The stock market collapsed, and a long economic depression followed, lasting until 1879. This crisis emphasized the risks of speculative investments and led to calls for stronger financial oversight. 4. The Panic of 1893. One of the most severe economic downturns of the 19th century, the Panic of 1893 resulted from a collapse in railroad investments and declining gold reserves. Stock prices plummeted, banks failed, and unemployment soared above 18%. The crisis led to debates over monetary policy and contributed to the push for financial reforms in the early 20th century. 5. The Wall Street crash of 1929 and the Great Depression. Perhaps the most infamous financial crisis in U.S. history, the stock market crash of 1929 led to the Great Depression, a decade-long economic downturn. Unemployment reached 25%, businesses collapsed, and banks shut down. The crisis led to major financial reforms, including the creation of the Securities and Exchange Commission, SEC, and the introduction of Social Security. 6. The savings and loan crisis of the 1980s. During the 1980s, deregulation of the savings and loan industry led to reckless lending and real estate speculation. As a result, nearly 1,000 financial institutions failed, costing taxpayers over $100 billion in bailout funds. This crisis led to stricter banking regulations and highlighted the risks of unchecked financial deregulation. 7. The dot-com bubble burst, 2000 to 2002. In the late 1990s, excessive speculation in internet-based companies led to a stock market boom. However, when many of these companies failed to generate profits, the bubble burst, wiping out trillions of dollars in market value. While not as severe as other crises, this event highlighted the risks of investing in overhyped industries. 8. The 2008 financial crisis and the Great Recession. Caused by risky mortgage lending and the collapse of major financial institutions, the 2008 crisis triggered the worst recession since the Great Depression. The housing market crashed, banks required massive government bailouts, and millions of people lost their jobs and homes. This crisis led to major regulatory reforms, including the Dodd-Frank Act, aimed at preventing future financial collapses. 9. The COVID-19 economic crisis, 2020. The COVID-19 pandemic caused a sudden and severe economic downturn, leading to widespread job losses, business closures, and stock market volatility. The U.S. government responded with massive stimulus packages to support individuals and businesses. While the economy rebounded quickly, the crisis accelerated changes in work, business models, and government spending. 10. The inflation surge of the early 2020s. Following the economic recovery from COVID-19, inflation surged due to supply chain disruptions, increased government spending, and rising wages. The Federal Reserve responded by raising interest rates, impacting borrowing costs and investment markets. This crisis reminded policymakers and consumers of the importance of managing inflation and monetary policy. Financial crises have shaped the U.S. economy by leading to regulatory changes and shifts in economic policy. Understanding these events helps individuals and businesses make informed financial decisions and prepare for future economic challenges.